Time now for On the Radar. It's a closer look at what a money manager's watching in the markets. We're back with Jamie Murray. He's president of Murray Wealth Group. He's going to take a look at 3 stocks that he thinks are good ones for investors to buy into right now. And the first one, as we showed you just as we went to break, is one that has really become a poster child in some ways for the aggressive tariff policy in the United States. But Jamie says you've got to understand the details. That's Linamar, the big auto parts maker. LNR has had a very, very difficult 52 weeks. It's down about 24%. The market obviously is worried about tariffs on this company as the U.S.-Canada auto manufacturing trade gets disrupted by tariff policies. Why do you like Linamar?
Yeah, so Linamar, I think it's important to understand that pretty much everything they make is USMCA compliant. And now that USMCA compliant goods are able to trade tariff-free, Linamar isn't really facing any tariffs. There is supposed to be some more, another report on auto parts tariffs coming up in the next, I believe in the next week. But we don't think there's going to be anything significant again for USMCA components. I think the big Detroit 3 automakers made it clear to the administration that, hey, we need Mexican parts, we need Canadian parts. The system doesn't work without that. And I think, again, we've seen the shift away from North American tariffs to the global tariffs. And so we see the Detroit 3 is actually relatively well positioned relative to some Asian or European automakers. And that's where predominantly Linamar over-indexes to those 3. And so we think their customers are going to be in a pretty good spot. Linamar isn't facing any tariffs. And, you know, a lot of the performance in the last year has been mostly multiple decline. The stock's not trading at a 5 times PE. There's lots of free cash flow coming in. They've rolled back their capital spending, and so they're buying back lots of stock. And so we think the stock's in the process of bottoming. Once we see the economy start to pick up, we're going to see Linamar shoot right back up to the $80 mark.
It's interesting you mentioned the economy because that has been a concern really on this sector before even the tariff situation exploded. There had been concern about economic sluggishness, concern about receding demand for automobiles around the world. The stock, Linamar stock, has essentially drifted sideways for about 5 years.
Yeah, and that's a fair point. I mean, they were seeing some pressure in both the auto parts, and they also have a large industrial division where they sell access lifts and some agriculture equipment. And they've seen some softening in those markets as well, but those are cyclical industries. They have every 1 or 2 years, they'll have a down year. But it's important to note that Linamar, we believe they're taking market share in both of those businesses. So when they do recover, you're going to see higher revenue and higher profit than you did in the last cycle.
Okay, let's move on to Whitecap Resources. You also like this one. It's in the middle of combining with Varen Energy, and you like that transaction.
Yeah, we really like this transaction. This has been a transaction that was always floated around as being sort of a match made in heaven, but it's always hard to get these deals done and bring 2 companies together. And you know, kudos to Whitecap and Varen for agreeing to this deal. They have very strong overlapping operations, both in their Montney and Duvernay positions, which is more your heavy, or your big wells, very expensive. And so having a larger land base allows you to optimize your operations better. And then they're both 2 of the largest producers in Saskatchewan and in those heavy oil markets that you see out in Saskatchewan. So again, optimizing the operations. And we've seen Whitecap be a very strong operator. They've beaten their production forecast, I think, 10 quarters in a row now. And so just the combined scale of these 2 companies coming together, we think is going to make a much more efficient operation. Okay,
and let's go to your third stock that you like in this environment, third Canadian stock, Air Canada.
Yeah, so this is one we've been burned on it once before, but you know, we're coming back to it. The shares are obviously sharply lower, really in the last 3-4 months, and part of that is this Canadians aren't traveling to the U.S. But we think that's, I mean, certainly that is the case. We're seeing that in the data, but we are seeing very strong demand across all other Canadian routes, both domestically, Canadian flying internationally to Europe, and recovering travel to Asia. So we don't think the demand picture is quite as bad as the market's pricing in. And again, this is another stock where the PE ratios just continue to drift down. It's now trading, I think, at a 5 times PE on 2026 numbers. And once they get through this 2 years of capital spending that they're doing, we're going to see tons of free cash flow coming out of Air Canada. Because at the end of the day, it is one of those world-class airlines with the loyalty program, the heavy premium economy that we're seeing do really well in this environment. And ultimately, the fleet size and the fleet ownership to survive through these slower markets like we're seeing.
That's Jamie Murray, and three stocks he likes: Linamar, Whitecap Resources, and Air Canada.